Very good morning, friends. So today we have got something very different. It's not an IND-AS, but it is supposed to be a framework on the basis of which the Indian accounting standards are built. So we're going to get some more, you can say, conceptual knowledge today, which is of course going to be a blend of a lot of theoretical base, which you're going to study today as well, different from what we have been covering so far. Coming from all those technical topics from business combination to consolidation and financial instruments, we are now coming to the conceptual framework which governs the drafting of the Indian accounting standards. Well, this framework, of course, has its own relevance, and there are certain stakeholders to which the relevance applies. Typically, of course, it applies to the Institute of Chartered Accountants, where when they draft a particular IND-AS, they do take the guidance in terms of what is mentioned in the framework. This framework has also undergone a change, and you've got a different framework under accounting standards, and you've got a different framework under the Indian accounting standards. There are a couple of things which are discussed in this particular framework, but I would first of all pick up the core areas of discussion, which is, I think, needs a little more insight. Typically, my focus will be on the measurement aspects which are discussed in the standard, the elements of financial statements which are given in the standard in the framework. So my two area of focus is going to be on the elements of financial statements. How does the framework define what is an asset, liability, equity, income and expense, and also what are the various measurement aspects? And as we go through those measurement aspects, you'll see a lot of things coming at the back of your mind. You will start recollecting the different measurement base which are there in different standards as well. I'm also planning a small little exercise as a value addition, that once we discuss the measurement aspects in terms of this framework, if we can possibly create a chart and recollect, which particular standard is giving you what kind of a measurement base. Because there is one very interesting question also, which I remember came in the RTPs as well, where they were talking about the inconsistency in terms of different measurement base which applies to various elements in terms of financial statements. Why does a particular standard tell you that we need to consider something like NRV for inventory? Why does the standard tell you something like IND-AS 36 when it says we need to consider the concept of VIU, or a fair value less the cost of disposal? At certain places, we are given to calculate the asset at a fair value. At other cases, we are given to calculate the concept of what we call a net fair value, that is a fair value less the cost to sell or less the cost of disposal. So what has been the thought process of the standard setters in terms of deciding the different measurement base? Basically, we're going to come to a lot of theoretical inputs today, but we'll take a lot of examples, connect the standards to make it more interesting. But of course, get ready for some more theoretical inputs coming your way. So let's begin the journey. So what we are talking today is in terms of what we call the conceptual framework. So we call this as a conceptual framework. And when we say it's a conceptual framework, it is for financial reporting under the Indian accounting standards. So we're looking at the framework with the help of which the financial reporting under IND-AS is done. This is not an IND-AS. To make it clear, this is not an IND-AS. So if there is anything which is given in the framework, does it get an overriding effect as compared to the other IND-AS? Of course not. So there are two things we need to keep in mind. One is that this is not an IND-AS, and the second is that if there is any kind of contradictions which happens in terms of the framework and the IND-AS, of course the IND-AS would prevail. Now, there are a lot of things which we need to understand in this particular standard. So I guess I'm just going to quickly take a run through in terms of what kind of different outcomes are we going to study. So the first thing is that we need to identify what are the objectives of a general purpose financial reporting. When I read the word general purpose financial reporting, what comes to the mind is there a financial reporting which is other than journal? Is there something which is specific as well? Yes. If somebody were to ask me that when we are looking at financial reporting, I would say the financial reporting could consist of, one is a general purpose financial statements, and other one is what we call specific financial reporting. I'll give you, for example, an instance of a specific financial reporting. Let's say, for example, a company is planning, let's say, fundraising. They're planning to raise funds, from international levels. Now, there is generally a requirement when a company is raising funds internationally, or even at times when you're going for IPO. You need to give at least 3 financial statements. So let's keep the example on a fundraising. So when you want to go in for a fundraising, let's say from an international country, you might be required to make certain specific financial statements to meet the specific needs. Because those people who go to finance your company need financial statements, let's say for the last 3 years. And then in order to meet the requirements, you might have to make financial statements meeting the certain specific requirements. So they are not general purpose financial statements. The general purpose financial statements is what you are making for the public at large. The normal annual reporting which a company does, which is shared to the various stakeholders of the company, is the general purpose financial statements. Now, when it comes to a specific financial statements, it is not to be circulated to the public at large. It is something which is meant for meeting certain specific requirements of the company. So one thing which we need to keep in mind is that the framework is applicable not to the specific financial statements, but it is supposed to be applicable to the general purpose financial statements. Next, we are given the inputs in the standard that we need to understand what are the qualitative characteristics of useful of financial information. When a financial information is given, it is of course a quantitative number. Now, when it is a quantitative number, it should also meet certain qualitative characteristics as well. Like, for example, relevance. Like, for example, faithfulness. We'll see those inputs later. But just to give you a broader idea, that all the financial information is got some qualitative characteristics as well. And then it says define the concept of financial statements and the reporting entity. Then comes the important input. What are the various elements of financial statements? What is an asset? What is a liability? What is an income and what is an expense? When I look at the elements of financial statement, it takes me back to school. And in order to understand the element of financial statements, what I'm going to do today, I will first give you a very generic discussion in terms of asset, liability, income, expense. The idea is also to give you a little more improvement in terms of understanding what an asset, liability, income, and expense implies. So what I'll do, I'll give you some generic discussion. I have created, like for example, an asset, a 3-step model, which helps you to understand the definition of asset, also to connect you to the conceptual framework as well. And then it comes, what is the criteria in terms of including the assets and liability? That's called a recognition criteria. And what is the criteria to remove them? And that is called a derecognition principle. You would have seen in so many standards. And I always tell people that when you look at, let's say, for example, any asset related standard, like for example, you look at PPE, or you look at intangible assets, or you look at investment properties, or even if you look at, let's say, biological assets, all these standards have given the definitions of asset. But just meeting the definition in itself is not enough. When you want to reflect the asset in the balance sheet, you also need to meet what is called a recognition criteria. You may meet a definition of an asset given in the standard, but unless and until you also meet the recognition criteria, you cannot show the asset in the balance sheet of the company. A definition is met, the recognition criteria fails, it cannot be included in the balance sheet of the company. Trust me, when different standards are framed, the framework of the standard, the structure of the standard is also broadly based on the principles which are given in the conceptual framework. Like for example, if you look at a standard, it'll give you a definition section. I'm not getting into the scope at the first. So they give you a definition section. And then after the definition comes the recognition criteria. So once you say that, okay, can I recognize the asset in the balance sheet or not? You meet the definition and you meet the recognition criteria. And then it talks about the measurement principles in the standard. What is the value at which it is initially measured in the books of accounts? What is the value at which it is subsequently accounted for? That is called the measurement principle. And then one fine day, the asset or the liability may have to be removed from the books of accounts as well, and that's called derecognition. Every asset, every liability related standard talks about a recognition criteria. When can you recognize it in the books of accounts? Also talks of a derecognition criteria. When is it supposed to be removed from the books of accounts? Now, if you look at the framework, they give you the principles which governs a recognition criteria, but the specific recognition principles for each standards, of course, can vary. So when it comes to a derecognition also, the framework gives you the general broader principles, what we need to keep in mind for derecognition. But when it comes to a specific standard, the derecognition criteria are framed in accordance with that particular standard. So the area is in terms of recognitions as well as derecognitions. And then comes the measurement base, which is, I think, a very important discussion. And if you ask me, I would like to love to do a lot of discussions in terms of the measurement base, because this is one very tricky area where we also tend to get confused. When we are doing these standards for the first time, you see plethora of measurement bases available in different standards. I think this is one area we're going to spend a good time on. And then it talks about the concept of presentations as well as a disclosure. And last but not the least, it talks of the concept of capital maintenance as well as the concept of what is called financial maintenance as well. Physical and the financial maintenance. Now, let me first of all connect you how this framework, as just a few minutes back, it becomes a base in terms of drafting a standard. So, as I just said a few minutes back, if you look at the journal structure of any standard, broadly any asset related, broadly any liability related standards, you will see that the standard is going to talk in terms of definition, and it will talk in terms of what I call the recognition criteria. This is like one block of discussions. And when I take up the asset related standards, I also tell people that your conceptual framework should be at the background. And when you look at any particular standard, you need to go in a chronological order. Because when you're looking at any asset or liability related standard, the block one is, do you meet the definition? And I would like to connect you out here. Let me first give you the chain, then I'll connect you out here. So the first input which a standard gives you is the definition and recognition. Do you meet the definition of a PPE, for example? Do you meet a recognition criteria? If yes, it appears in the balance sheet as an asset. Then next comes the measurement base. What is the value at which the asset is initially measured? What is the value at which it is subsequently measured? Now, connecting you to the framework, it is important to understand. When the standard setters created, the different standards, and they were creating the measurement base, what was going at the back of the mind was the implications. What was going at the back of the mind is the implications of these measurement bases in terms of the balance sheet of the company and in terms of income statement. And you'll see within this conceptual framework some very interesting charts where the implications of the measurement bases in terms of the balance sheet and the income statements are given. How does the measurement base impact my P&L accounts so that indirectly a profitability can be understood? Because the thought process of the standard setters has been very clear that when you're looking at a different standard prescribing a different measurement base, the idea is to understand the implications of the base on the valuation on the asset and liability, as well as the impact on the profitability in terms of income statement. Then comes the area, after this, I would say, is supposed to be the area where the standard talks of the derecognition principles. It talks about the derecognition criteria. Derecognition criteria would mean, when do I remove the asset from the balance sheet of the company? When do I remove the liability? Like, for example, in financial instruments, you saw the derecognition principles of financial assets, the derecognition principles of financial liability. So there is a criteria, and if you see, if you remember Ind AS 109, the derecognition principles on financial assets was comprising of various kind of tests. They prescribed a cash flow test. They prescribed the concept of a risk and reward test, as well as the concept of a control test. So the broader framework is out here, and then these framework is utilized in creating the different standards. And then comes the aspect of presentation. Then comes the concept of a presentation. How do you present the asset or liability or the income and expense in the financial statements of the company? How are you going to present the component of the item in the balance sheet, in the income statement? So this presentation is in terms of financial statements, in terms of a balance sheet, and in terms of an income statement. And last but not the least, when a standard is created, you can see that in the end, it gives you all the disclosure requirements as well, which are to be given in the notes to accounts. So there is another input, which is the disclosures. And these disclosures are given in terms of the notes to accounts. Now, I think I would like to connect the dots at this stage. Why I'm spending a little more time in terms of framework, because we need to first get a broader idea. What is this framework all about? Where does this framework help the standard setters? Now let's get the connect out here. You can see, first of all, out here, we are given what is the criteria for including the assets and liabilities in the financial statements, recognition criteria. And this is what I gave you is the recognition criteria. The base is out here. Then it says the derecognition. When you remove the items from the balance sheet, and that becomes a derecognition criteria. And then you can see it talks about the measurement basis. And this is what we are looking at, the measurement base. And then it talks about the presentations and the disclosure. So there we've got the presentations, and there we've got the disclosure requirements as well. Trust me, the flow of every standard, you pick up any standard for that matter. Well, of course, not all standards may have a derecognition principle, for example. But just look at, for example, IS 16, look at IS 38. You'll see the flow very clear. They'll talk about the definition and recognitions. They'll talk about the measurement base, then the derecognitions, the presentations, and the disclosure requirements. And of course, when it talks about the various elements like assets, liability, incomes, and expense, this is again the definition section which is coming in. So you can connect very clear that the standards are drafted considering the definition sections. Then you can say the recognition and derecognitions, the measurement base. So this becomes the core area. So this is how the conceptual framework is being drafted, that the conceptual framework is given to the standard setters that they can use it. But that doesn't mean that this conceptual framework has got no role for the preparers of financial statement. It is important for the standard setters, but it is also important for the preparers of the financial statements as well. Because before you come to the conclusion that, as a qualified CA, the standard setting is not my job, so why should I be concerned about this conceptual framework? Many a times when you are going to apply a particular Ind AS, due to the fact that there may not be a, let's say, a clear-cut treatment given in the standard, many a times it'll happen that there will be certain gray areas in the standard. While drafting the accounting policy in those gray areas, you'll have to come back to the conceptual framework. And whatever is the accounting policy choice you're going to pick up all depends upon the parameters that you're going to apply the conceptual framework. I hope, friends, now this helps. I think my base introduction would have at least given you some basic importance of what this conceptual framework is all about. Let's take the inputs further. Okay, so this is the unit overview. I am now going to first of all bring you to a little more introduction at this stage. So let's give you a little more introduction of what I've already said. I'm just going to show some more inputs to you at this stage. Well, I guess let's have a look at the introduction, which is given in Unit 1. This framework has been divided in various units. It's running in quite a lot of pages. So, of course, I'll prioritize my discussions on certain relevant inputs. So, I'm going to start my discussions on the concept of measurements directly, because that is one area which I think is very interesting, and I think something which opens your mind as well. Now, it says the conceptual framework for financial reporting under Ind AS is not a standard. I already gave you that it is not a standard, and it does not override. And it does not override any standard or any requirement in the standard. So these are two basic inputs which you need to keep in mind, that this conceptual framework is not an Indian accounting standard, and it does not override any standard nor any requirement in any of these standards. Therefore, it does not form part of the set of standards pronounced by the standard setters. While the conceptual framework under Ind AS is primarily meant, I very clearly said it is primarily meant for the standard setter for formulating the standard. It has got a relevance to the preparers in certain situations. So, of course, it is primarily important for the standard setters, but nevertheless, I said it is also important at times for the preparers of financial statements as well, such as to develop consistent accounting policy for areas which are not covered by a standard, or where there is a choice of accounting policy, and to assist all the parties to understand and interpret the standard. And they give it a couple of examples out here as well. For example, if you look at Ind AS 1, for example, if you look at Ind AS 8, or for example, you look at Ind AS 103, they require the preparers to follow the guidance which is given in this conceptual framework. Because many times the companies might be creating accounting policies which are not specifically addressed by the specific standards, and then the preparers is going to make use of that. So I think we've got three highlighted points which I would like to document at this stage. So I guess the key inputs is, the key takeaways, I would say, in this particular case, that as far as the framework is concerned, let's put this as a heading. So we can say, number one, it's not an Ind AS. That is one takeaway. The second is, it does not override. It does not override any Ind AS or any requirement of Ind AS. It does not override any Ind AS or any requirement of Ind AS. And the third key takeaway is that it is primarily meant for standard setters. It is primarily meant for the standard setters. So if you're looking at the application of this conceptual framework, it is primarily meant for the standard setters, though we can say preparers may sometimes. So we need to say preparers. So we can say the preparers of financial statements, we can say, would also be needing this as well. So preparers of financial statements in certain situations would need to apply the framework. So this is the broader takeaways which we have understood out of the conceptual framework on financial reporting. Right, friends? So this is the introduction. I am now going to take a little jump and take you directly to the measurement basis as well. Okay, so this is unit 1, which gives you the introduction in this particular case, and let's now go further. So there are various units which have been organized in terms of things. I'll not get into the broader theoretical inputs at this stage. We'll come back to them once we get a little time, but I think let's first start with the core area, which is, I think, the measurement unit 5, elements. I'm going to first of all come to the aspect of the measurement base. Just give me a second. Let me just come to that part. So this is the wonderful part. Okay, let's have a look now as far as the measurement is concerned. Now watch this carefully, because I'll do a little more extensive discussions based on this unit number 7. Now there is some lot of informations which are covered in this particular unit. And the idea is, that we understand the broader principles of measurement and how those broader principles have been applied in the different areas of these standards. Let's have a look. Let's first have a look at the particular chart. It's a wonderful chart which has been created. And I'm going to do some value additions, so don't worry, the notes will come later. We'll first concentrate on the broader principle. First of all, it says that elements recognized in financial statements are quantified in monetary terms. And this means that you need to select a measurement base. For example, we need to decide, do we consider historical cost, or do we consider a fair value, or do we consider what is called a fulfillment value? Now, this is one term which perhaps you might not have heard earlier. So the terms which are used is historical cost, fair value, or a fulfillment value of an item being measured. Applying a measurement base to asset liability creates a measure for that asset and liability and also for the related income and expense. Now, understand this very important part. When in a particular standard, the standard setters, decide that this is the measurement principle, for example, historical cost, it not only decides the value for the balance sheet perspective, but it also has implications on the income statement as well. So the measurement base is not only impacting a balance sheet, but also impacting the profitability of the company as well. Now, let's look at this particular chart. We can see on the measurement base, broadly, there are two measurement base. One is called historical cost, and the second one is called a current value, which has got a total of 3 variations. It is called a fair value, it is called a value in use for the assets, and it is called a fulfillment value for the liabilities, and there is a current cost. So I think we need to first of all understand what are these different measurement base. Historical cost, we are all quite aware, but we need to more understand that when I say current value, in which we are looking at a fair value, or we're looking at a current cost, that is a current value, current cost, or what we are looking at a value in use, or what is called a fulfillment value. Now let's, I think, first understand these broader terms. So we are given, first of all, a very broad comparison between historical cost and a current value measurement base. So this is the broader difference. I'll come to that, no worry. And then I just want to show you some charts at this stage. Just have a look at the chart in this particular stage. So let's first just have a look at the thought process before I take you further. You can see in the study material, the inputs are given regarding historical cost, impact on the assets, impact on the liabilities. And then it comes discussions on the current value. It tells you about the current value, the fair value concept, the value in use or the fulfillment value. And then there is more data. And if I connect it further in terms of this again gives you the inputs on the balance sheet and the P&L impact. Asset side of the balance sheet, as well as you can say the statement of P&L. Then you can see more inputs coming in, some wonderful charts out here. So this is giving you more inputs about the P&L and the balance sheet impact. Then you can see the liabilities discussions. Wow. And then you can see more discussions continued. Superb. And this is what is there. So I am going to spend time on these charts 1, 2, 3, 4, 5, 6, 7. We're going to spend time, friends, on these 7 charts, 7 pages, which I believe is one of the most core area. The theoretical inputs is something which you will easily understand after reading. But I think we need to understand the broader outlook in terms of how the measurement base impacts a balance sheet. How does it impact an income statement, whether it's with reference to asset, whether it's with reference to liability, and how the various standards have taken these particular inputs in the framework in terms of creating chart. Let's begin the journey. So first of all, what I am going to do, I'll divide my discussions in 2 parts. First, let's understand what is a historical cost. And also let's understand what is supposed to be a current value. So we'll first understand the broader inputs, historical cost and a current value. And then we'll also understand the 3, you can say, variations in terms of current value. This will be one part, understanding historical cost, current value, which has got 3 variations: the fair value, the value in use, the fulfillment value, or you can say the current cost. Then we'll go to the implications of these items on the balance sheet as well as on the income statement. So let's begin. So if we look at the broader comparison between historical cost and the current value, it is given. It says monetary information. It talks about the monetary information about assets and liability and related income and expense. It is derived at least in part from the price of the transaction or the other event that gave rise to them. We always use a term called transaction value. We use a term called a transaction value. For example, if I took a loan, then I would say I took a loan, let's say 10 lakh rupee. So what is the value at which I did a transaction? That's 10 lakh. That is called the transaction value. I purchased an asset, let's say for 10 lakh rupees. So what is the value at which I did the transaction? It is 10 lakh rupee. So when you say the historical cost, it is the price of the transaction. We can indirectly call this as a transaction value. We can call this as a transaction value. Now, I would just like to remind you, when you did the concept of Ind AS 109, and if you remember, financial assets and financial liabilities, we said, are always taken initially at a fair value. They're not taken at a transaction value. And if you remember, in my discussions out there, I just like to connect you back. For example, when you recorded a financial asset, the entry was financial asset gets a debit and the bank gets a credit. And we said this is the transaction value and this is the fair value. So please also remember one very important element. If you're going to record an asset at a transaction value, then it will not lead to any differences in initial recognitions as well. But if you're going to record an asset, let's say at a fair value, it will also lead to a differences in the initial recognition as well. So which means the recognition of an asset at a fair value or the recognition of the asset at a transaction value will have implications on the income statement also on an immediate front. I hope I'm making sense. Then he says current value is using the information. It says it is using the information which is updated to reflect the conditions at the measurement date. So when you apply the historical cost, it is a transaction value, though the balance sheet is made after a couple of months. Because when the transaction happened during the year and it is still reflected in the balance sheet at a transaction value, it is not an updated information. But when you consider the concept of current value, the thought process is that you are basically updating the information to reflect the conditions which are prevalent on the measurement date. So for example, the standard setters thought that when you're going to consider financial assets and liability, we need to consider for certain financial assets and liability an updated information. They wanted to incorporate all the information which is present on the measurement date. But let's say, for example, if you look at a PPE or intangible, we thought the transaction value is supposed to be good, but we gave a choice that if you want to consider an updated value, you can. So this is one input. The information comes from where? Where do you get the information? Parameter one. Second. Then comes the aspect of changes in value. So when you consider historical cost, the changes are not reflected. The changes are not reflected. But I like to tell you one thing. When you consider historical cost movements, in those particular cases, increase is not captured, but decrease is definitely captured in the form of an impairment. So when it comes to a historical cost measurement, we can say, except to the extent that those changes relates to impairment of an asset or a liability becoming onerous in nature. So let's remember, we'll make some charts later, don't worry. So we can say a historical cost information is going to give you the inputs in terms of transaction value. Any updation reflecting increase? No. Any updation reflecting decrease? Yes. For assets impairment, for liabilities, there is a concept of onerous contract, what you've done in Index 37 as well. If you look at the current value, do we consider the changes? Yes. Since the previous measurement date, in estimates of cash flows and other factors are reflected in current values. So here you do not capture the increase, but you capture the decrease. Here you capture the increase as well as the decrease, both are captured into account. So what your mind should be clear on is the source of the information. What is the source of historical cost? What is the source of the current cost? And then we need to be clear in terms of capturing the changes in terms of value. Where do we capture increase, decrease, and where do we do not? It's journalistic, but I think still we get the inputs. Okay, now let's go to the other factor, the components of the current value. So before we discuss the impact on the balance sheet, let's, I think, first have a look in terms of the other components of current value. So let's have a look out here. Now we need to consider the various, you can say, variations which are given for a current value. The current value is got, we said, a total of three valuations. One is called a fair value, and one is called a VIU for asset, or a fulfillment value for a liability. So let's now consider this. What's this? You've seen a bit inputs in Index 113 as well. When you look at the concept of a current value, there is an exit value and there is an entry value. When you look at the concept of a current value, there are two values. One is called exit value and one is an entry value. You will recall the principles which you studied in Index 113. I don't know if you've covered Index 113 so far. But if not an issue. There are two things. When I buy an asset, in this particular case, I pay a price to acquire an asset. So what I pay to acquire is what is called entry price. That is what is called an entry price. So entry value is what is called what I paid to acquire an asset. On the other hand, if I say, what do I get to sell the asset? So there are two prices, like for example, if you look at an asset. For example, if you look at an asset, so we can say what is paid to acquire. What is paid to acquire the asset? The focus is on the cash outflow. The focus is on the cash outflow, that what is paid to acquire the asset, and therefore this is called entry price. This is called entry price. But when we say what is going to be received, what is going to be received to sell the asset, then this becomes the focus, that is a cash inflow. What will you get to sell the asset? That is a cash inflow, and this is what is called an exit price. that if you're going to sell the asset, this is exit. If you're going to acquire the asset, that is called entry price. So when you're looking at the concept of a current value, the standard setters were very clear that the current value has got two inputs. One is called an exit value and one is called an entry value. Of course, you can see the exit values for asset liability differently and entry values also differently. Now see what it says. The exit value has got one variation which is called a fair value. Fair value is also defined separately for assets and liability. Fair value is also defined separately for assets and liability under the framework of Ind AS 113, where it talks of that in terms of asset, it is supposed to be what you receive to sell. And in terms of liability, what do you pay to transfer, not to settle? Not to settle. So in this particular case, when you're looking at a fair value, asset means what is going to be received to sell. And in terms of liability, what are you going to pay to transfer? So this is what you receive to sell. And as far as liability is concerned, what is you pay to transfer a particular liability? Then comes the concept of what is called another variation of a current value, and this is called value in use for an asset, and it is called a fulfillment value for a liability. So let's now understand a little more detail as well as a fulfillment of value. Then we'll make some notes on that, no worry. Let's go further. It says in terms of the fair value, price that would be received to sell an asset or what is paid to transfer a liability in an orderly transactions between market participants at the measurement date. Mind the words. The fair value is again supposed to be computed on the measurement date, and the value is derived on the basis of the market participants. Let's go further. It says value in use is the present value of the cash flows and which the entity expects to derive from the use of the asset and its ultimate disposal, something what you use in terms of Ind AS 36. That VIU is supposed to be the present value of all the future cash flows arising from the continuous use of the asset and its ultimate disposal. And then it says a fulfillment value is again a present value of the cash or other economic resources the entity is expected to be obliged to transfer as it fulfills a liability. So this is like again the concept we can say settlement. This is again called settlement because when you're looking at the present value of all the entity is expected to be obliged as it fulfills a liability. The word is focused out here. It fulfills a liability. So I think let's put it like this. Let's put it like this. I would say the concept of a fair value for an asset is what you receive to sell. For a liability is what you pay to transfer. When you're looking at the concept of exit value, VIU, it's a present value of cash inflow. For a liability, it is a present value of cash outflow, which is based on a settlement value. So this is more like a settlement value for a liability, and this is more like a transfer value for a liability. So the distinction comes in terms of, you can say, the concept of fulfillment is settlement. The concept of fair value is not fulfillment, but transferring the liability from one to another. Next. Value from whose perspective? This is important. The perspective of the market participants is taken into account. This is not entity specific. This is not entity specific, what you might have learned in terms of Ind AS 113. When you calculate the fair value of the asset liability, we will create an artificial transaction between independent buyer and seller, not perhaps the real buyer and seller. The calculation of the fair value in this particular case is based on constructing a particular transaction between, you can say, a buyer and seller, and not necessarily the real buyer and seller. But when it comes to the concept of VIU, it reflects an entity-specific assumptions rather than the market participants. I know you would say, can you draw a little more light on that? I'll just do that. Let me consolidate the picture. Let me first take it further, then I'll consolidate the inputs to you. So let me just, I think, take this a little further, then I'll consolidate the picture. So the other inputs which are given in terms of how do you determine the valuations as well. So it says it is by observing the prices in an active market or using certain measurement techniques like the cash flow based measurement techniques. It cannot be observed directly and is determined using cash flow measurement techniques. So this is based on observable data. And this is based on unobservable, though you can say it can be observable as well as unobservable, but this is always, you can say, unobservable data. I'll consolidate, don't worry. And then it says the transaction cost, is it considered in measurement? In a fair valuation, we never consider the amount of transaction cost. We do consider transportation cost as per India's 113 as well, but we never consider any TC. And these costs incurred on the initial recognitions are not considered, but the present value of those costs to be incurred on disposal are supposed to be considered. Let me consolidate. I know a lot of data coming in. Let me consolidate the picture. Now, hear me clear, then I'll make some charts to you. I'm now coming to, first of all, the broader inputs in terms of historical cost as well as current cost. Then the variations in terms of the current cost in terms of fair value, in terms of VIU, or what we call the fulfillment value, and in terms of the current value. Now let's look at this. We're yet to discuss the current value. Let's come back on the picture. Now, if somebody says what are the broader measurement principles given in the framework, I would say there are two broader frameworks which are given. The measurement based number one is historical cost. Now, when I look at the concept of historical cost, there are two questions which comes to my mind. Number one, what is the source of historical cost? I would say the source of historical cost is supposed to be the transaction value. That is the first question what comes to the mind, is that what is the source of this information? It is the transaction value at which you enter into the transaction. So it is easily determinable. A company enters into a transaction and that value is the transaction value. Number two, when you consider a historical cost, do you capture the changes in the valuations on the balance sheet date? If it is increase, no. If it is a decrease, yes. And decrease in terms of assets would be impairment, and decrease in terms of liability would be that they become onerous in nature. I hope you got the 2 points clear. So you should be clear about the source of the historical data, transaction value, and the capturing the changes in the value. Increase, no. Decrease, yes. Now comes the next input. The second input is the concept of a current value. When you say current value, what comes to the mind is, okay, let's forget about the three variations at the moment. So again, tell me the two inputs, what is the source of the current value and do we capture the changes or not? The source is in terms of updated information on the measurement date. So we say, okay, you're going to make a balance sheet on a particular date. So let's see what is the date at which a measurement is happening. So updated information on the measurement date is considered. Second, do you capture the increase or the decrease? The answer is yes. The increase is also captured and the decrease is captured. So two fundamental clarities: source of the information for historical as well as a current value. And number two, the changes are captured or not. One, don't worry, we'll document that. Now we come to these three variations which are given out here. So now we come to these three variations which are given. The current value is got variations like broadly divided in terms of two parts. When you're focusing on the current value, broadly divided in two parts, one is called the exit value and one is called the entry value. Now let me also tell you something about the entry value, which is current cost. It can be called as a replacement cost. If you recall, for example, in terms of Index 2, when you consider the valuation of the raw material which is consumed in the finished goods, we do consider the concept of a current value, but that current value is supposed to be an entry value because inventory in terms of FG is taken on the basis of exit value. But inventory in terms of raw material is taken on the basis of entry value, where you say that the value of the raw material depends upon the valuation of FG. If the FG is taken at NRV, then the raw material is taken at cost or replacement cost, whichever is less. The replacement cost is nothing, but that is supposed to be an entry value. That is supposed to be an entry value. So it is used in that particular standard. Now, let's concentrate on this part now. Now, when you consider the concept of a current value, I would say there are two broad areas. One is exit and one is entry. Entry, as we have seen, is the concept of replacement cost, which is called a current cost. But when you look at an exit value, there are two connotations of an exit value as well. One is called a fair value. Now, fair value for an asset means what? What do you receive to sell? Fair value for a liability means what? Fair value for a liability means what do you pay to transfer? Secondly, when you consider the concept of a value in use, it's a present value of future cash flows. When you look at a fulfillment value for a liability, it is again a present value, but it's a settlement value. It is a settlement value. The difference is a fair value for a liability is not a settlement value, transfer value. But when you look at an exit value out here, it is supposed to be a settlement value. So we need to understand now again the sources of this information and all. So broadly looking at the inputs. When you look at the concept of a fair value, where do you get this information from? It is based on the market participants' information. Is it based on the real buyer and seller? No, it's not based on the real buyer and seller. So it is based on the market participants, not the real buyer and seller. Is it entity specific? No, it is a market-based measurement. It is a market-based measurement. It's not who sells, it's not who transfers the liability. It is supposed to be based on the market information. The principles you have learned in terms of 113. This is entity specific and this is market based. So that is one area of distinction. This is supposed to be market based information. This is entity based information and the other parameters of differences. How do you determine it is observable plus unobservable? It is purely unobservable data. And when you look at the concept of transaction cost, it is not considered. And this is considered at the stage when the final disposal of the asset takes place. So we do consider when you incur the money at the time of disposal or settlement of the liability. So 3 broad principles to be kept in mind for these two inputs. Number one, when you consider fair value, it is supposed to be market based. When you consider the VIU fulfillment value, it is supposed to be entity based. Number two, when you consider a fair value, it is observable, unobservable data. When you consider the concept of VIU fulfillment, it is supposed to be entity specific based information. The role of TEC in terms of fair value, no. The role of TEC in terms of VIU and fulfillment value, yes. When you dispose the asset and when you are going to settle the liability. And lastly, I would also like to say, emphasis fourth point, this is transfer and this is settlement. I hope friends you got the broad outlook in terms of the two variations of current cost, current value, that is fair value and VIU. Current cost I've given you is broadly supposed to be a replacement cost. I think time to document some notes as well. Did you get the input so far, friends? What we discussed, the broader principles? Wonderful indeed. So let's now make some charts at this stage before we go to the implications on the balance sheet aspect. Let's also have a little inputs on the current cost as well. Then we can just add on just last little chart on the comparison between the current cost as well. So the next difference is in terms of HC as well as current cost. Current cost, we said, is also an entry value. So how is the value determined? Of course, at each measurement date. This is on the date of acquisition of the asset or the incurrence of the liability. And for assets, it is consideration paid plus TC. Liabilities, it is consideration received minus TC. Here it is consideration that would be paid plus a TC that would be incurred, and liabilities that would be received, and minus the TC that would be incurred. So can you see the difference in terms of current cost? It is more futuristic in nature. The consideration that would be paid and the TC which would be incurred, liabilities is again that would be received and minus the TC that would be incurred. Let's now make a brilliant chart at this stage. So let's look at the measurement concept. Let's look at the measurement bases which are given in the framework. So let's see the measurement bases which are given in the framework. So we can say the measurement basis which is given in the framework, if I were to just sum up the inputs in terms of things, I would say there are basically two broad valuations which are given in this standard. One is we call historical cost. One is what we call a historical cost. And the second one is what we can say is supposed to be current cost. It is supposed to be a current cost. Rather, I'll call it as a current value because current cost is a part of the current value. So let's call this as a current value. So when you're looking in terms of the current value, this can be broadly again divided in two parts. One is we can say is a fair value. One is what we can say is a fair value, and the other one is supposed to be a current cost. These are the two variations in terms of current value. And then when you're looking at the fair value, this is again broadly divided in two sections. One is you can say, let's put this as exit entry. So let's put this as exit value and this is entry value. So when you say exit, the connotations is a fair value, and this is in terms of for an asset, it is supposed to be VIU, and for a liability, it is supposed to be a fulfillment value. It is supposed to be a fulfillment value in terms of a liability. And when you say entry, this is current cost. This is supposed to be current cost in nature. Okay, so this is the broader picture which is there in terms of the measurement bases which are given in the framework. That we've got historical and current values. So what we're going to do, we're going to first of all look at the differences between historical and the current values. So let me just put some inputs out here. So we will first of all look at the difference between the two. So we are looking at the difference between the two from two perceptions. So we're looking at the difference from two perceptions in this particular case. So when I'm looking at the broader difference between historical cost and the current value. So this is historical cost and this is the current value. So we want to look at the differences in terms of, you can say, the source, and number two, the changes in value. That do we capture the changes in value or not? So in this particular case, when you're looking at the source, we can say it is transaction value. It is supposed to be transaction value at transaction date. It is transaction value at a transaction date. The date when you transact, that becomes the source of the historical cost. So in particular, we can say that if I want to define for an asset, if I were to define for an asset what is paid to acquire, what is paid to acquire. And you can say for a liability, if I were to put it, I can say what is received when you got the liability. As far as the current value is concerned, it is supposed to be updated. It is supposed to be updated on measurement date. It is supposed to be updated on the measurement date. Typically, you can say the balance sheet date. So changes in value as far as increase is concerned, no. As far as a decrease is concerned, yes. And when you say a decrease, the decrease would be in terms of asset. It can call as impairment. In terms of asset, it is impairment. And in terms of liability, it is becoming onerous in nature. It is becoming onerous in nature. And when you look at the changes in value, it's increase as well as a decrease. The answer is yes in both the cases. So this is the broader difference in terms of historical cost information and the current value. Now with this inputs, we'll be able to appreciate also the impact on the income statement, because this will also give you implication. We are, just to remind you, on two broader areas of discussions. One area of discussion is what are these values? The second implication is that what is the impact of these values on the balance sheet as well as on the income statement. That is the second area of discussions. Okay, now let's go further. Let's now talk in terms of the other chart as well. So now we are looking at the differences which is there in terms of this exit values only. We're looking at these two values. Entry, we can put it separate. So we're looking at the differences in terms of the fair value and the fulfillment value, a part of. So this is based on, you can say, the exit values. These are supposed to be the exit values. The focus is only on the exit value. So we're focusing on this area, not that area. So in terms of the exit value, we've got one of the variations is called fair value. And the other one is supposed to be called VIU for the asset and a fulfillment value for the liability. So VIU as well as a fulfillment value. Now let's see the broader differences between the two. So one of the differences is that when you're looking for an asset and when you're looking for a liability, so fair value in this particular case would be, you can say, what do we receive? What do we receive to sell? And in terms of liability, we can say, what do we pay to transfer? So what do we pay to transfer? So this is the key inputs, transfer, and this is sell. When you look at the VIU, it is supposed to be the present value of future cash flows. It is the present value of the future cash flows. And this is again the present value of the future cash flows. This is to settle. This is in order to settle. So this is future cash flows which will arise from the continuous use of the asset, from the continuous use of asset and its disposal. So what is the present value of all the cash flows arising from the continuous use of the asset as well as its disposal? Next, we're looking at the source of the information. And if you look at the source, it can be observable. it can be observable, but it can also be unobservable as well. So it can be observable directly or indirectly observable, or it can be totally unobservable. And this is completely unobservable in nature. So this is all estimations. It is unobservable data. It is all unobservable because it is only estimates. You're making an estimations of the expected cash flows which will arise. It's all unobservable data. Then next we can see the inputs that it is based on. It is based on, you can say, supposed to be, rather I would say, based on, we can say, market-based measurement. It is market-based measurement. Where do you sell is the important aspect. It is not, the company-based information. It is, different companies selling in different markets where the product is sold at the max. It's a market-based measurement, and this is entity-specific. This is entity-specific measurement. So this is based on what the company in question is there. So it is entity-specific, totally in contrast. Okay, so this is one inputs, which is what is the source and all these things. And number 4, we can also add the concept of transaction cost. We can also add the role of the transaction cost as well. In this case, it is ignored. And in this case, it is considered. In this case, it is considered on disposal of asset. It is considered on disposal of asset. So when you go to settle, or when you go to settle the liability, settlement of liability. So whatever TC is incurred on disposal of the asset or settlement of the liability, that is, of course, considered in this case. Right, friends, so far so good. So I think this gives us a broader overview of the different measurement bases which are given in this standard. Right, let's now take the journey forward. So I'll just make a little mention on the current cost out here as well. And on the current cost, we can simply say this can be called as a replacement value. This can be called as a replacement value. So let me also give you a little broader chart in terms of historical cost and the entry value as well. Or rather, let's put it out here. So in terms of the replacement value, we can say for the asset as well as for the liability, we can say for the asset, it is what would be paid, to acquire, and this is what would be received. What would be received, this is important. So this is what is actually paid. So this is what is actually paid and received. So let's put it like this. This is what is actually paid or received, and this is the focus would be. So this is hypothetical in nature. Right, I guess, friends, now we get a broader outlook in terms of the different measurement bases which are given. So my mind should now be very clear that if somebody tells me that what are the different measurement bases, let me put it like this. I would say one is historical cost. And I would say the number 2 is supposed to be, you can say, the current value. Now, when it comes to a current value, there are a lot of connotations. The current values is got, number 1, is it based on an exit value or is it based on an entry value? If you say it is based on an exit value, then there are again 2 connotations which comes in. One is that it is a fair value, and one is that it is a VIU or a fulfillment value. And the connotation in terms of the entry value is supposed to be called the current cost in nature. You can see various standards are taking various measurement bases depending upon the facts and circumstances. Just to give you a broader outlook, just an example on each one of them. When you consider the concept of historical cost, the concept of historical cost typically, if you notice, is being restricted mainly to non-financial assets and non-financial liabilities. Because the moment it comes to financial assets and liability, the concept of historical cost is not there. Even the initial measurements are at a current cost, which is a fair value. So the typical, you can say, concept which the broader outlook, the standard set is applied as far as the historical cost is concerned, quite limited to the concept of non-financial assets and non-financial liability. When it came to the financial assets and liability, they started looking into the current values into account. Not that in terms of non-financial assets and liability, the concept of current cost doesn't exist. It does exist. Like, for example, in terms of inventories, when you are looking at a raw material, the concept of entry price has been built. So the current cost is there, but based on the entry value. And when you're considering in terms of the inventory, the exit value is more based on this. NRV is more like a value in use. What will you get if you sell this price? Estimated selling price is taken. But when it comes to the financial assets and liability, the fair value concept has been taken. So you can see that this concept has been taken more in terms of non-financial assets and liability, largely. When you look at Index 36 impairment testing of non-financial assets, these concepts have been inbuilt. And if you see the concept of financial assets and liability, the fair value has been built. So broadly, this is not 100% correct, but broadly, if you see, when the standard setters were creating the standards, I think the basic thought process based on the frameworks has been that when you're focusing on non-financial assets and liability, let's go with a historical cost concept, at least for their initial measurement base. But when it comes to a subsequent measurement base in terms of updations, because you need to capture the falls in the values and all, so they wanted to broadly consider this particular concept. That is the concept of entry and the concept of the VIU. But when it came to the broader concept of financial assets and liability, the concentration was more on a fair value. You'll see lesser applications of these components in terms of financial assets and liability. So what I'm saying is based on my inputs in terms of what you can see in different standards. So I think when they were drafting standards, the broader principles which they took into account was that financial assets liability, let's concentrate here. Non-financial assets liability initially out here and subsequently in terms of the. This is what the basic thought processes has been. If you get time, we'll try to make some charts as well towards the end where we can see some permutation combinations in terms of different financial, non-financial assets, their initials and subsequent measurements are taken at what base. We'll see. We'll give you a chart today on that. Okay, so with this inputs now, let's go on to the broader inputs now. My first input is done. I've given you the broader discussions in terms of what are the different kinds of measurement bases available, what kind of inputs they consider, and what is the source of those inputs, etc. Now comes the crucial questions that once you've selected these measurement base, what is the implications on the balance sheet carrying values? What is the implications in terms of the income statement? How does it impact the profits, etc.? So let's have a look out here. So I am now going to take you further and we're going to now, So we're now going to look at the assets. Our focus, first of all, is going to be assets. Let me just give you the thoughts again. We're going to focus on the assets. You can see the balance sheet impact of these values and the income statement impact of these values. I think it's a wonderful job done in the study material, making all this information. I thought, before giving you any theoretical inputs and all, let's concentrate on the core part because measurement is what decides everything. So let me just also take this further. So this is the extended chart. So this is the extended part. Just give me a second. Let me just, organize the data. This is on the second. Then focus comes on the liabilities. Then the focus is on the liabilities part. I'm just cropping them up so that you can zoom it and see it well. This is now balance sheet impacts and the income statement for liabilities. Continued. So this is again a wonderful chart created on this particular part. Yes, that's great. So 1, 2, 3, 4. Okay, so coming back to the chain, just to give you the chain correct once again. Now we are looking at our second area of discussions, that for assets 1 and for liabilities 2, what is the impact of different measurement bases available? You can see the focus, it is assets. So you can see the focus out here, it is on the assets, the balance sheet impact, the statement of P&L impact. This continues, and then you can see the focus is on liabilities, the balance sheet impact, and the P&L impact. So what the study has been done in the framework is that when you consider a different measurement base for an asset or liability, what is the impact on the balance sheet and what is the impact on the P&L? I think this is one thing which the standard setters incorporated when they drafted, the various standards, and the different measurement bases were decided under various standards for different assets and liability. So let's come back on this area. Now let's see. If you look at number 1, the historical cost, we're looking at the carrying amount. Historical cost is the extent of unconsumed, uncollected, and recoverable. Oh my God, I love the words. I love the words. If you actually now start thinking, I personally believe, a person, if you start a conceptual framework before the standard begins, he'll not understand anything maybe. Because, once you've learned more of accounting, you will be able to appreciate more of these terms after you've done the accounting different standards. Now look at the words, interestingly. It says it is the extent of unconsumed. Like for example, when you consider a PPE, what do you show? You show the unconsumed benefits. As the plant is being consumed, you keep charging a depreciation. So what represents in the balance sheet is the benefit which is yet to be obtained. So the value of the asset based on historical cost is the benefits which are yet to be obtained. It's unconsumed in nature. And it is uncollectible and recoverable. Like for example, when you consider a trade receivable became an exception to the concept of fair valuation. If you remember, in terms of Ind AS 109, all financial assets are taken at fair value, but as far as a trade debtor is concerned or a trade payable is concerned, it is taken at a concept of a transaction value, which is nothing but historical cost. Because what is the amount of sale, the sales value is recorded as a debtor. Now, when you measure the debtors in the balance sheet, it is the amount which is yet to be collected, but you also take the impairments into account. So you consider what is recoverable as well. So all the assets in the balance sheet are also subject to impairment testing because they need to be presented, number one. They need to be presented, number one, at the amount which is unconsumed, uncollected, but also considering recoverability. So Ind AS 36 or even Ind AS 109, impairment aspects have been built in. So the standard setters had this broader framework that every asset in the balance sheet needs to be subject to impairment because it cannot exceed its recoverable amount as well. Whether it's a financial asset, it is subject to impairment testing under 109. If it is a non-financial asset, it is subject to impairment under Ind AS 36. And then it comes to current cost to the extent unconsumed, uncollected, and recoverable. The concept is again based on the same principle. Even if you consider the current cost as well, the current cost is also based on the same concept. The only difference is that this data is a transaction value and this is on a measurement date, but the broader principle in terms of the measurement remains the same. The broader principle remains the same. If it comes to a fair value, it is price that would be received or price that would be to sell the asset. And in this particular case, most of the cases you would see that impairment testing is not applicable. the impairment testing, the recoverability is not applicable. But of course, there are exceptions. Like for example, if you consider your debt investments at FPTOCI, it is subject to fair value, but still it takes a deviation from the principle that impairment testing is applied. But the broader principle is what? When you consider the item at a fair value, it is not subject to impairment testing. When you consider the broader principle, if it is a historical cost, the recoverability is there. Current cost, the recoverability is there. But in this case, the fair value itself ensures an impairment. But then fair values were divided in terms of fair value through P&L, fair value through OCI, etc. And then it says this is the present value. It's entity specific. It is market specific. Present value of future cash flows from the use of the asset and ultimate disposal. So the basic thought process of reflecting the values of the asset in the balance sheet on a historical cost basis is unconsumed, uncollected, and recoverable based on the transaction value. In terms of the current cost, same principle, but based on the measurement date. In terms of fair value, the exit price, what do you get to sell the asset? What do you get to pay to transfer? But assets we are talking, so only for assets. And in terms of VIU, the present value of all the cash flow. The role of the TC. So when you reflect the value in the balance sheet, do you consider the transaction cost? Like for example, you buy a machinery and you pay a brokerage, etc. Do you include the brokerage, etc.? Yes, it is. When you consider, let's say, for example, a current cost, it is taken. A fair value does not consider any TC. It is without deducting the TC on disposal. But you can see there are concepts like fair value less the cost to sell. There are concepts like fair value less the cost of disposal, which are variations to the concept of fair value. You know, what comes to the mind later would be, you'll say, sir, fair value, you said TC is not taken. That's a broader principle. But when it comes to the calculations of the variations in terms of fair value, the variations is fair value through P&L, the variations is fair value through OCI R, the variations is fair value through OCI NR. Those variations have taken deviations from the conceptual framework as well. And accordingly, they've decided that TC will be taken into account or not. And then it says after deducting the present value of TC as well. So you need to continuously keep in the mind that when you look at the specific standards, the conceptual framework is a base, but then there have been a lot of variations which are created in the specific standards when it comes even to the role of transaction cost. Because the fair value itself, I said, has got various connotations: FPTPL, FPTOCI. And this is R, and this is NR. So in all these cases, they've created variations as well, dependent upon the conceptual parts. Okay, so this is how the carrying values would appear in the balance sheet. What is the basic, you can say, thought process of measurements and the role of TC? These are the two inputs there. Next. If you look at the impact in terms of initial value, when you are going to record things at historical cost, can it ever lead to a difference at time zero? No. If you remember financial asset, the entry is financial asset debit fair value, bank credit transaction value results in initial recognition difference. So in terms of initial recognition, in this particular case, there is no differences which can arise. In this case, there is no differences which can arise. But in this case, a difference between the consideration paid and the fair value arises. Like for example, you've done this in terms of Ind AS 109. That when there is a difference between a transaction value versus a fair value, how do you treat the difference? Remember the case of employer-employee relationship? Remember the case of supplier-customer relationship? Remember the concept in terms of the holding and subsidy relationships? How would the difference between the amount received, the amount which is paid, versus the fair value accounted for? So there will be a difference at initial recognitions as well. Even when you're going to consider the VIU, there will be a difference between the consideration paid and the VIU as well. Though, to my mind, if I look at the assets, are they initially ever recorded at a VIU? I would say no. The use of VIU has been limited only in terms of the balance sheet dates. The use has not been there in terms of the initial recognitions. There are assets which are initially taken at fair value, but I don't remember any of these standards taking a note of the fact that initial recognitions of assets are taken at a value in use. It's only at the year end. So when it is at the year end, of course, differences would arise not initially but subsequently. If there is a transaction cost in this particular case, then it says transaction cost adding on. The transaction cost in this particular case, I guess this is expense, that is right. Let's, I think, go further. Okay, now it says there is a sale of the asset or there is a consumption of the asset. Consumption would be reflected in terms of, you can say, the expense in the form of depreciation. So we can say the historical cost of the assets sold or consumed, the cost of sales of the inventory. So we do reflect a depreciation in this particular case. When you look at inventory, when the inventory is sold, it is put into the expense, that is income statement. When the asset is consumed, you put the depreciation in the income statement. And in this case, also the current cost of the asset sold or consumed. Even if you take a raw material, let's say at a current cost on the consumption of the raw material, it will also impact the income statement. So you can say that when items are measured at historical cost, the consumption of the asset becomes an expense. Whether it is inventory, then the cost of the inventory. Whether it is a PPE or intangible, the depreciation. Current cost, again, the expense. When you consume the asset, then of course it becomes an expense. Here it is the fair value of the asset sold or consumed, and here it is the VIU of the asset sold or consumed. Which means that at the end of the day, what is charged in totality? What is charged in totality over a period of time? What is charged in totality over a period of time in the income statement is historical cost, current cost, fair value, and VIU. If you actually look at this, what are you charging? You're charging on an overall basis historical cost, current cost, fair value, and the VIU. This is going to be charged in the income statement over the period when it is being consumed or when it is sold. When the asset is sold or when the asset is consumed, so during the course of sale consumption, you can say it gets charged as an expense in the income statement. That's what I tell people at times. Anything which is recorded as an asset in the balance sheet, one fine day will definitely enter the income statement. Imagine the statement. When a company incurs an expense, you create an asset or you create an expense at that point of time. When you incur an expense, you start looking at, is the benefits already obtained or is the benefits yet to be obtained? If the benefits have already been obtained, it becomes an expense at time zero. And when you say the benefits are yet to be obtained, it creates an asset at that point of time. But later, as the benefits keep getting consumed, it is definitely enters the income statement. A machinery in the balance sheet will one fine day over the life of the asset enter the P&L as an expense. The inventory recorded as an asset in the balance sheet one fine day will enter the P&L as a cost of sale. Every asset in the balance sheet one fine day will enter into the P&L. The timing factor could vary. It could be in single one go in terms of sale of inventory, or it could be spread over a period of time, like for example, depreciation. Okay, then it comes to the expenses and income. Okay, now let's come to the next one. I guess let's consider TC, we're done. Now let's consider the interest income. Now let's consider the interest income, impairment, and the value changes, which are the core important area. So as far as the interest income is concerned, it is at historical date, updated in the asset base variable rate. If you remember, When I did my discussions on Ind AS 109, and if you remember, at this stage, I had concentrated on another variation, which is called an amortized cost. If you look at the broader principles given in the framework, they are talking of historical cost only. And I was quite quiet on the concept of AC because I thought I'll come to that at an appropriate point of time. So when it comes to these standards, you can see that the variations in terms of historical cost concept has also been developed, considering the concept of interest income and interest expense. And if you recall, you would appreciate that the interest income and interest expense under historical cost accounting is always recorded at a contracted rate. But when it comes to an amortized cost principle, the interest income and expense is recorded on the basis of, what is the effective interest rate. So that variation is being created in the different standards as well. The framework is talking of historical cost, not amortized cost. But when it came to the applications in different standards, a variation is created, just like the variations of fair value in terms of FPTPL, OCI, etc. The variations in the historical cost model is also been created. Because one of the demerits of the historical rate is that you are basically considering a contracted rate to record the interest income. But in some cases, we don't want to capture, what is the income you're earning on a contractual basis, but what is the substance of the legal form, EIR. And then it says this is at current rates. And this is already included in the fair value changes. So the interest income is not captured separately. But of course, let me tell you that when you come to standards like financial instruments, you would see that debt investments are taken at fair value and they're taken at FPT-OCI. Still, you capture the interest income on EIR. So the general broader principle is that, in this particular case, it is already taken care by the fair value changes, but we do consider that as well. Here also, it is already included. So, as you read, please get the frameworks also very clear in the mind. This is a broader inputs given in the framework, that the principles is that if you consider interest income, historical cost, yes, current cost, yes. If you look at a fair value or a VIU, no, it is inbuilt because the fair value changes will capture the interest income. Impairments is an expense, and it is already included in fair value. So impairment testing's not done. Here also, it is already included. So impairment inputs are not identified specifically. Value changes. Do we take the increase or decrease? Increase, no. But yes, impairment for financial assets. Here, the effect of changes in prices are taken. Here, this is not and this is not. We already consider the fair value changes are already taken. So automatically, the inbuilt fair value changes are captured. So let me just, consolidate this inputs to you. So we'll just broadly have a look on the assets part in this particular case. Before we'll give you a break as well on this. Quite a lot of theory, I guess. But it's a little more practical oriented theory. So what is now coming at the back of my mind is, when you're looking at the measurement of an asset, the measurement of the asset could be broadly based on the four principles, as we can see: historical cost, current cost, fair value, and you can say VAU. We're not looking at a liability at the moment. The focus is in terms of assets. So the framework says that assets can be measured either at historical cost. It does not give you the variation of AC. It talks about the concept of a current cost. It talks about fair value. It does not talk about the variations in terms of FPTPL, FPT-OCI. It only tells you the fair value as a broader framework. And it talks about the concept of value in use. So just to remind you, these are the exit value, this is the entry value, and this is, of course, the historical cost. So we're looking at that when the asset is recorded in the balance sheet at these different measurement bases, then what is the value which appears in the balance sheet? In terms of historical cost, it is transaction value, unconsumed, uncollected and recoverable. In terms of current cost, same principle, but on the measurement date. This is the information on transaction date. This is the information on the measurement date. And this is the price that would be received to sell. This is the present value of cash flow. So this is, the deeper meaning. What is the value at which the assets are recorded in the balance sheet? So depending upon the nature of the asset, the standard setters decided to choose that which concept seems to be more appropriate to reflect a carrying value of the asset in the balance sheet. And the role of transaction cost, it is added to the asset. It is added to the asset. It is ignored. It is ignored totally. And in this case, it is considered in the calculation of the present value. So you can see that this is like an outflow to calculate the net value. This is ignored and this is added. So the broader principle becomes clear that when you consider the asset value, what is the value at which it is shown in the balance sheet? The role of TC. Two things. Next. In terms of the impact on the P&L, I would say initial differences could arise in this case. Yes, this is generally, I would say, doesn't arise because we don't use the concept of VIU on initial recognition levels. So initial differences would arise typically in terms of fair value only. And at the end of the day, the total pressure, I would say this is the total impact on the income statement. Whatever asset is there in the balance sheet, one fine day will enter into the P&L as well. And the impact would be that in this case, the entire historical cost will enter the P&L one day, entire current cost, fair value, and the VIU. As and when the asset is sold or as and when the asset is consumed, this will be the total impact on the income statement over the life of the asset, I would say. Then comes the concept of, you can say, the interest income. It is contracted rate. It is at the current rates. And this is, you can say, practically ignored. Impairments, yes, yes, no, no. Value changes in this particular case, decrease, yes, increase here. This is, of course, increase, decrease, whatever. And this is the impact. So I think let's make a small little quick chart on the impact of different measurement bases, giving you some very core areas of principle. So let's make a small little chart and then we'll give you a break as well. So I am now looking at my second area, that is the impact of the measurement bases on the balance sheet and on the income statement as well. So we've got four broader principles: historical, current cost, fair value, and the VIU. So we're looking at a small quick summary. This is the impact of various measurement base. This is the impact of various measurement base, which is on the balance sheet as well as on the profit and loss, or we can say the income statement. So we've got historical cost, we've got current cost, we've got fair value, and we've got VIU. So these are the different measurement bases available. So let's, I think, go with first of all the impact in terms of balance sheet. I want to look at two things. What is the carrying value? I want to look at the carrying value and I want to look at the impact of the transaction cost. So in terms of the carrying value, this is unconsumed. This is, I would say, unconsumed, or we can say it is, which is not yet collected, or let's put it as unconsumed. I use the same term, uncollected. So unconsumed, uncollected, and in this particular case, it is recoverable as well. It is recoverable as well. This is also the same. It is unconsumed, uncollected, and recoverable. But the only difference in this particular case is this is based on, we can say, transaction date. This is based on the transaction date. And as far as this is concerned, this is based on measurement date. This is based on what we can say is the measurement base. And the next, when you look at the fair value, this fair value is supposed to be the price to be received. This is the price to be received on sale of the asset. That is the focus point. And when you look at the VIU, it is based on the present value of future cash flows. It is based on the present value of future cash flow. So this is the essence at which the assets are carried in the balance sheet of the company. The second aspect is the role of TC. In this particular case, the TC is added. In this particular case also, the TC is added. In this particular case, it is ignored. And in this particular case, we can say it is considered as cash outflow for calculating present value. It is considered as a cash outflow for calculating the present value. So it is not added, it makes the value down, it decreases the value down. So this is on the balance sheet front. Now let's also look at the income statement, that is P&L front as well. So if we look at the income statement, we can say, let's put one or two items. Let's consider impairment. So as far as impairment is concerned, yes. As far as current cost is concerned, I would say it's more like inbuilt. And fair value also, I would say it's more like inbuilt. And as far as VIU is concerned, I would call it as inbuilt instead of saying something different, because the moment the assets are taken at current cost, the moment they're taken at fair values of VIU, it's an inbuilt impairment testing. So impairments are not subject to. And we can say the total expense is based on historical cost as there is when you sell the asset or it is consumed. In this case, the total impact is the current asset as the asset is sold or it is consumed. Here, the total impact is the fair value. And here, the total impact on the income statement is VIU. And I think one more point I would like to add is the interest income on the asset. So here, the interest income is on a contracted rate. In a current cost, I would say it's not applicable as such, or we can put it as a contracted rate. Let's say not applicable. Fair value is based on, so as far as the fair value is concerned, we can say it can be based on, or we can just ignore it. But I'll just put an asterisk where we can say it can be EIR. So it can be effective interest rate in cases like debt investments at fair value. Right, so this is a little quick overview in terms of the assets. So this is what we are looking at, the assets. So this is the entire chart as far as the assets are concerned. That what is the impact of these assets using different measurement bases in terms of balance sheet values and in terms of income statement impacts. Right, friends, I think it's time now to give you a break as well. I'm sure you'll need one. So I think let's take a break. What I'm going to do, friends, with you, we're going to discuss the liabilities, and I am planning to give you a very interesting chart since we've discussed the concept of the measurement base. Or maybe before we go to the liabilities part, let's do one thing. Let's give you a wonderful chart on assets, that various assets, like, different standards, the assets are taken at what values. Are they subject to initial impairment? Are they subject to impairment? What is the concept of interest incomes? What is the initial subsequent measurements? I am very interested in giving you the chart, combining, giving you the inputs of various standards put together, at least around 5-6 standards, if not financial, then at least non-financial in nature. What do you say? Is it a brilliant idea? That would be great. Yes, I'll give you a chart which is going to summarize the different measurement bases, the application of this conceptual framework to different assets in the balance sheet. So then we can do that exercise for a liability as well. So let's, I think, first take a break, relax our mind. I'll join you in 10 to 12 minutes time. Enjoy your break.
So, sir.
Yeah.
सर आपने थर्ड क्लास में स्टार्टिंग जो क्लास थी, थर्ड नंबर की जो क्लास थी, लाइक 21 उसमें
Mhm.
आपने ओसीआई आर एंड एनआर का डिस्क्रिप्शन दिया था।
हाँ
उसमें
जी।
आपने कहा था कि वेरियस स्टैंडर्ड्स में अलग अलग आर और एनआर कंसिडर करते हैं।
हम्म,
तो सर अब हमारे स्टैंडर्ड्स कंप्लीट हो चुके हैं, देन आप प्लीज उसको ना उस चैट को फिनिश करा लीजिएगा।
ओके। मैंने वो चार्ट बेटा वैसे फाइनेंशियल इंस्ट्रूमेंट्स के अंदर दी थी। मुझे
हम्म।
याद नहीं, मैंने शायद दी थी नहीं दी थी या रह गई थी बिकॉज ऑफ टाइम शॉर्टेज। नो प्रॉब्लम, सो आई डू वन थिंग। आई फर्स्ट गिव यू द एसेट चार्ट, then I'll give you
ओके
the R&R chart also, right?
ओके सर, थैंक यू।
Done. No problems. I'll give it to you. Welcome back, friends. So I hope you had a relaxation of mind. I guess, as I promised before the break, I am now going to give you the application of this framework to different measurement principle bases which are decided in different asset related standards. So let's make a wonderful chart which is going to give us a summary view in terms of how the framework has been applied to different standards. Now, what is going at the back of my mind is the inputs in terms of Index 2 inventory, then Index 16 PPE, then Index 38 that is intangible, Index 40 that is investment property, then Index 41 that is biological assets, then I'm also considering Index 105 that is NCA held for sale, and I'm also looking at financial assets that is Index 109. Is there anything else you want to include in the list? Or I think these 7 items good to go. I just gave you the list. Index 2, then there is Index 16, Index 38, Index 40, Index 41, then Index 105, and then Index 109. So 7 kind of assets, the definition parameters kind of thing. Or maybe we can just concentrate on the measurement part and the other aspects. So their initial measurements, their subsequent measurements, the concept of depreciations, the concept of impairments, etc. Good to go. Is there anything else you want to add to this chart? Or I think 7 assets are great. I'll just make the framework. Let me know if you want to add something more. So I'm looking at the application. I'm looking at the application of the framework, to various asset related standards. So we're looking at the application of the conceptual framework to various asset related standards. So I guess I'm going to make a total of 8 columns in this particular case to give you the permutations and combinations. So I am considering a total of 8 columns. One is for the particulars and one for each of the standard as well. So 1 column we'll take for particulars, then 7 columns Index 2, 16, 2 columns, 3, 4, 5, 6 and 7. So 2, 16, 38, 40, 41, IFRS 5 and financial assets. I think that's good to go. So let me just put down the items as well. Let's take the column for particulars and let's look at the concept of inventory. Let's look at property, plant, equipment, intangible assets, investment property, biological assets, of course, other than bearer plant. And then there is NCA held for sale. And I'm looking at financial assets as well. So these are all supposed to be non-financial assets. They're all non-financial assets in nature. So we are dividing the categories non-financial and financial. So let's begin the journey. And in between, you can keep putting questions to yourself. If you can answer majority of these questions, that means your concepts are going great. So I will put some parameters, and the parameter is, first of all, I will look at the standard number, and then I want to look at the measurement. And in terms of the measurement, I'm focusing in terms of initial measurement, and I'm also looking at a subsequent measurement as well. And then I'm looking at inputs in terms of depreciations or amortization. And I'm also looking at inputs in terms of impairment. Is there anything else you want to add to this list of particulars? Do let me know. I'm concentrating on the measurement aspects and on the depreciations, impairment aspects as well. So let's begin the journey. And I'm going to add on a little more inputs in this chart, maybe a little beyond what you're thinking. So as I put the inputs, questions, try to answer that in the mind. If you want, you can answer them on the chat box as well. So inventory, of course, the number is Index 2. PPE is Index 16. Intangible is 38. Investment property is 40. Biological asset is 41. Non-current asset is 105. And this I'll put it as 32 plus 109 both. Though typically the measurement is 109. Now let's look at the initial measurement. Inventory is taken at historical cost. The property, plant, equipment is again taken at historical cost. The intangible assets are again taken at historical cost. The investment property is again taken at historical cost. The biological assets are taken at a fair value less cost to sell. And you can notice now, as I said, largely the standard setters, while deciding the measurement base for a majority of the non-financial assets, had the historical cost concept in the mind. The only exception which came in terms of a non-financial asset was a biological assets, where they decided to consider the concept of fair value. Otherwise, largely, the concept of non-financial assets are based on historical cost measurements. Now, when you come to the NCA held for sale, the initial measurement is supposed to be the book value or the fair value less the cost to sell, whichever is less. So I would just like to pinpoint that these are, the two areas of exceptions in a way, because everything is practically taken at a historical cost movements. The only two non-financial assets which were taken at the concept of a fair value, which is considering the concept of a current value. So this is a variations in terms of the current value, because we've took fair value less the cost to sell as well. Financial assets, of course, initially are all taken at a fair value. So they're all taken at a fair value. I guess let's also add the elements of TC in this case as well. So when there is a TC in the initial measurement, you add the TC. In this case, the TC is added. Any transaction cost is going to be added in terms of all these assets. But when it comes to biological assets, the transaction cost is not taken. When it comes to NCA also, there is no role of TC. And in this case, we can say the TC is added, except, would you like to tell me which is the exception? Where a TC is not added to the financial assets. Because whether subsequently it's taken at AC or FPT OCI or FPTPL, in all cases TC is added, but in one case it is not added. And that is supposed to be FPTPL. If you take your investments, financial assets at FPTPL, then it is not supposed to be added. Okay, now let's come to the subsequent measurements as well. And in terms of inventory, I would say it depends whether you're looking at FG, WIP, or it is raw material. The FG and WIP is taken at cost or NRV, whichever is less. But when it comes to FG, it depends upon raw material. It depends upon the FG valuation. If the FG is at cost, the raw material is at cost. If the FG is at NRV, the raw material is at replacement cost or cost, whichever is less. I don't know. I don't have enough space to fit in out here. So let's just make it small. FG and WIP is supposed to be cost or NRV, whichever is less. And I can just add some inputs out here that if you're looking at raw material, then it depends upon the FG. If the FG is taken at cost, the raw material is also taken at cost. If the FG is taken at NRV, the raw material is taken at cost or replacement cost, whichever is less. So this should be very clear at the back of the minds that when you're looking at a raw material inventory valuation, then the concept of, you can say, the replacement cost, which is supposed to be the current cost, is being inbuilt. Okay, then let's come to the PPE. The PPE is supposed to be cost or revaluation model. You've got an accounting policy choice. It is cost or revaluation model both for the intangibles as well as for the PPE. This is supposed to be an accounting policy choice. The company can choose any one of the two. And for the investment property, it is cost only. The concept of fair valuation was not allowed, unlike it is allowed in the international standard. In IS 40, the fair value concept is allowed a cost or a fair value, but under the Indian scenario, only a cost model was prescribed. And I would also like to draw some attentions at this stage. In terms of the revaluation model, what you've done in Ind AS 16, the concept is increase goes in OCI and the decrease enters in the P&L. But in terms of the fair value model, which is given in IS 40, which was not allowed in India, the concept is the fair value gain and the loss both goes in the P&L. So I think that creates a lot of volatility in terms of the P&L. And therefore, you can say, in this case, when they came to a revaluation model, it's a blend of FPT OCI and FPTPL. I always tell people that in terms of Index 16 and Index 38, they've taken the blend of FPTPL and OCI, because when you park the increase, it goes in OCI. When you park the decrease, it enters the PNL. It's like a dual model where you've taken the fair value through PNL OCI blended. But in terms of IS 40, which was not allowed in Index 40, the fair value concept is FPTPL. The gain and loss enters in the PNL, and that was not allowed under the Indian scenario. So biological assets, of course, they are again taken at a fair value less the cost to sell. And for the non-current assets, it is again at the end of the year taken at a fair value less the cost to sell. The financial assets are subsequently taken at either amortized cost or at FPT OCI or at FPTPL, depending upon the categories, and this is either R or it is NR. So the thought process of the standard setters was different in this particular case. They wanted to consider, in this particular case, different kinds of variations based on the intentions. The intentions reflected in the business model of the company, the intentions in terms of is the investment for trade or not, all that decided the feature. Now, let's come to the other inputs in terms of depreciation, amortization. Inventory, it's not applicable. PPE, yes, the depreciation is taken. Is there any exception where depreciation is not taken for a PPE? Any exceptions? Where
Land.
depreciation? Yes. You said something with a land, correct? That's right. And similarly, when you look at intangible assets, amortizations is taken. Any exceptions where the amortizations are not taken for the intangible assets? Goodwill. Then there is supposed to be intangible assets with an indefinite life. Then I would say intangible assets under development. So here also we've got some exceptions. I'll just add the exception somewhere. I'll just put it out here, the exception. So in terms of intangible assets, we can give you the list of exceptions as well. And the exceptions are three. Goodwill is not supposed to be amortized. Intangible assets under development, that is not supposed to be amortized. And intangible assets with indefinite life. Intangible assets with an indefinite life, they are also not supposed to be amortized. They're all impairment tested. These are all intangibles which are impairment tested. Investment properties, yes, they're depreciated. Biological assets, no. Non-current assets held for sale, no. Financial assets, no. Depreciations, amortizations, not applicable. Then in terms of the impairment testing, inventory, I would say, is inbuilt, because when you consider the inventory at cost or NRV, whichever is less, there is an inbuilt impairment. PPE, yes, impairment is done. Intangible, yes. Investment property, yes. Biological assets, no. Non-current assets held for sale, no. Fair value, we can say only if measured at. So they are impairment testing only if they are measured at you can say amortized cost or fair value through OCI, that is R, not in terms of NR, not in terms of FPTPR. I hope, friends, that chart helps you a lot. It summarizes the different aspects in terms of the measurement principle governing different kinds of financial, non-financial assets for the balance sheet and the impairment and depreciation. So this is more the impact on the balance sheet front, and this is more the impact on the income statement, that is P&L impact. Right. I guess, friends, this chart helps you in terms of giving you a quick overview, a summary view of different things. You can even expand this chart further in terms of adding the definition, the recognition principles as well, mapping the entire framework which is given in terms of the applications and different standards. Like there are, for example, a total of 6 parameters for NCA held for sale. So you could quickly add on what are the 6 parameters as well. You could broaden this chart, adding the definition, recognition parameters, and if you want the derecognition parameters also, and that can give you an entire input in terms of framework application. Right? I hope the chart was good. So it's going to help you. Let's, I think, take it further. So I am now on the other inputs. I have to give you another chart as well, which I promised. That's going to be on the elements as far as the concept of OCI R&R is concerned. That's wonderful indeed. Okay, so now let's, I think, discuss the liability part. Then I'll come to that part in terms of giving you that OCI element as well. Because this is one core area which I wanted to discuss in the framework. Because, other areas which are theoretical, I think even if you read them, you understand them well. I wanted to make the best input in terms of the time, because it's difficult to cover everything in the framework, and some things which are theory, you do understand that. Now let's come to the liabilities, the balance sheet, and the P&L impact. So we're looking at what is the carrying amount in terms of historical cost. So we can say this is the consideration received. In simple words, it is the transaction value for taking the unfulfilled part of the liability and increased by the excess of estimated cash outflow, blah, blah, blah. I think let's put it like this, that when it comes to a liability measurement, it is the amount of consideration received, transaction value. Then he says, and that is for the unfulfillment part of the liability, consideration that would be currently received for taking the unfulfilled part. I don't really remember, and I don't think so, I can really connect to this part where any liabilities in the Indian accounting standards have been taken at a current cost. Do you remember any kind of liabilities which are taken at a current cost? Because they're either taken at, a concept of cost, historical cost, or at the basis of fair value. I really can't recall at this stage that if there is any liability which is been measured on the basis of current cost principle. Liability price that would be paid to transfer the liability, and a fulfillment value is the present value of the future cash flow. So the concept is same. The consideration received, then this is consideration that would be currently received. This is on the transaction date. This is on the measurement date. This is the price which is paid to transfer, not settle, and this is based on the present value. The deeper meaning in terms of the 4 different definitions of liability. What is the role of TC? It is subtracted from the value of liability. It is subtracted, it is ignored, and it is taken into account in the calculation of the present value as well. You're going to consider that as a part of the cash outflow, same concept. So this is the larger input. What does the meaning, what does the value imply, and what is the role of the TC? And let's see the income statement impact. The chart is wow, helps us to revise in exams, great. I'll also give you that chart of OCI, ICAI. Rather, I'll give you the entire SOKI, which will give you a detailed inputs of all standards, which is, permutation combination of OCI. Wait and watch after this one. Okay, in terms of the statement of P&L, I guess if you use a fair value concept, the initial differences can arise. Fulfillment values, I think I'll leave that part. I'll just now quickly go to the value changes, etc. So nothing much to put on the liability front. So if you look at the interest expense, it is at the contracted rates, it is at the current rates, and in this case, it is already included. So saying that the concept of the, you can say the interest expense does not arise. Yes, it does not arise. Liabilities do not have a connotation like FPT-OCI. Liabilities have only the concept of FPTPL. So all liabilities in terms of financial liabilities are all measured at FPTPL. So we don't see the concept in terms of recording any interest expense. The fair value changes indirectly, takes care of that. And what is the impact if there is increase or decrease in liability? So in this particular case, we'll take the concept of onerous into account. So this will consider the concept of onerous contract. Here you will take the fair value increase, decrease, both will be captured, and here also already included in it. And as far as the value changes are concerned, I think I'll put that in chart. So let me just make a quick chart on the liability front. So we'll just make similar to the assets a liability chart as well. So the balance sheet impact. So we're looking at the balance sheet carrying values and the income statement. So we've got 4 categories in terms of liabilities as well. So we just see the balance sheet and the P&L impact in terms of liability, and then I'll take it further to give you that very interesting chart. I'm eagerly waiting to make that chart. So let's see the application of framework. The application of framework in terms of the framework, rather we can say the measurement aspects. So the application of the measurement, which is going to be on the liabilities. So application of the measurements on balance sheet and income statement. This is for liabilities. This is on the liability side. So we're looking at liabilities measured at different measurement bases. What is the carrying values in the balance sheet and what is the income statement impact? So let's take a column for particulars. Historical cost, then this is current cost, fair value, and this is fulfillment value because we're liability, not VIU. So we're taking a fulfillment value. So let's first of all see the balance sheet impact of these items. So if I'm looking at the balance sheet effect, we can say what is the value at which it is recorded in the balance sheet. And we also need to look at the role of the transaction cost in this case as well. Historical cost is supposed to be the consideration. What is the consideration received? Whatever is the amount received. So this is indirectly we can say a transaction value. Let me just also slip this below. So we can say in terms of the current value, this is again the consideration received. This is consideration received. The only difference is this is the consideration received on the transaction date. This is the consideration received on the transaction date, and this is the consideration which will be received on the measurement date. That is on the balance sheet date generally. And when I'm looking at the fair value, it is supposed to be the amount to be paid. This is the amount to be paid. The focus is to be paid on transfer, not settlement of a liability. So what is the amount you will pay to transfer the liability, not to settle, but to transfer it to another party? And if you're looking at a fulfillment value, it is based on the present value of future cash flows. So it is based on the present value of the future cash flow. Now, in terms of the role of the TC, it is subtracted. It is supposed to be subtracted. Here also it is subtracted. And in terms of fair value, we can say it is ignored. And here it is considered. Here it is considered as cash outflow for present value computation. This will be considered as a cash outflow for the present value computations. Now, though we say it is ignored, but you can see that many standards, like for example, Ind AS 109 for financial instruments, allows you to consider the TC as a part of the adjustment to the carrying value. Okay, now let's look at the income statement impact. So in terms of the income statement impact, we want to see that when it comes to interest expense, when it comes to an interest expense, you consider contracted rate. In terms of current cost also, we can say contracted rate. Here I would say no, inbuilt kind of a concept. Though when you take your financial liabilities at a fair value, which is AC initially, you do apply EIR, but per se, we don't take interest expense. So we can say the changes in value, the changes in terms of value. So do we capture an increase? Yes. Do we capture a decrease in this case? Ideally, no. So when do you capture the increase? When it becomes onerous in nature. So when it becomes onerous in nature, you capture the increase in the liability. In terms of current cost, we can say if it is increase or decrease, I would say yes, because you're taking the balance sheet measurement aspects. Fair value also, yes, we take the increase and decrease. And fulfillment value also, indirectly we can say yes, it takes into account the increase and decrease both. Right, so this was a summary in terms of the impact of the different measurement bases available for liabilities in terms of the balance sheet and the income statement. So my journal framework in terms of the measurement aspect, which is one of the core components of the discussions, is done. So I guess now I am interested in making a chart, but that would mean I will skip the theoretical aspects of the conceptual framework. I hope that is fine. Because if I'm going to make the chart, I will be skipping the theoretical discussions on the framework. I'm happy to do that. Does that work for you? So, yes or no? Yes, great.
Sir,
Haji beta.
in case of liability, fulfillment value when we take, in calculation of present value calculation when there is increase or decrease in liability value, discounting rate will also change.
Discounting rate would be dependent upon, like for example, if you look at the concept of fulfillment value, accordingly, discounting rates would be based on the measurement dates. So why are you looking at a discounting rate? I mean, I didn't really get your question.
So like a lease liability calculation when there is a modification to the contract terms and we take a effective new rate on the modification date.
Correct. Got your point. You see, yes, as per the framework, they're not talking of these things. As per the framework, this guidance is not there. But when it comes to specific standards, they've given you the insights in terms of when you take a present value, what kind of discounting rates are to be chosen. If you look at the framework, they don't tell you that what kind of discounting rates are used. That is specific standard based. That guidance is given in the standards. Correct.
Okay, sir.
Okay, now I think let's come to an interesting chart, friends, to you. This is going to consolidate a lot of inputs in terms of things. I always see people, always looking at, oh my God, what is this OCI? Which standard, which OCI is given? Is it R? Is it NR? What happens to that amount at a later stage? So I'm going to spend now 15-20 minutes giving you a wonderful chart, but this will consolidate all the different indices you have done in life. Are you ready? Yes, let's begin. I'm going to connect this discussion through SOKI. So I'll give you my thought process, which I'm giving you original chart. You're not going to see this chart anywhere. This is exclusively for the students watching the ICAI YouTube channel. Exclusively only for you. So what I'm looking at is the statement of changes in equity. And let me give you my thought processes. If you've seen the very few initial lectures, the introductory lectures I gave you, that SOKI is divided in terms of three parts. That is what I call a tab 1, tab 2, tab 3. Today, I'm going to tell you that what are the origination points of these tabs, when do these tabs originate, and when do these tabs actually, finish. So I'll give you two aspects. When does the amount in a tab get created and when does it get derecognized and it pushes to which tab? Get ready now. So I am looking at, first of all, the column. This is particulars. Let's keep it short. This is tab 1, this is tab 2, and this is tab 3. Now, this is my column for particulars, and this is my tab number 1, which is basically equity component of CFI. This is equity component of compound financial instruments. Then we've got a tab number 2, which is basically reserve and surplus. But within this reserve and surplus, there are a couple of more items also that is supposed to be, you can say, capital reserve, security premium, retained earnings. Typically, I would say these three components. And then there is a tab number 3, which is supposed to be other comprehensive income. Now, I think let's begin our discussions in terms of the tab number 1. I want to see when does a tab 1 get created and when does it get knocked off, when does it finish. So let's consider, first of all, the tab number 1. If you look at when the tab number 1 gets created, if I look at when does the tab number 1 get created, it is on issue of compound financial instruments, where we apply the concept of split accounting. And when you apply the concept of split accounting, the component, the equity component of the CFI enters this particular tab. And it remains in the tab till the, you can say, the particular, you can say, instrument is derecognized. So when does it get derecognized? When is the derecognition applied in this particular case? So I would say it is on, you can say, redemption. It is on redemption of the given instrument. Now, I would like to remind you that in terms of the tab number 1, if you look at, let's say, convertible instruments, the holder may either ask for a cash, the holder may either ask for equity share, because generally when you look at compound financial instruments, what comes in the mind is a optionally convertible instruments. And in those particular cases, the holder at the end of the tenure may ask for cash or he may ask for shares. So when he says that on redemption he wants cash, then this money is transferred to the capital reserve. Then this money is transferred to the capital reserve. When he says, I want a cash, the money in tab number 1 is directly pushed to the tab number 2. This is supposed to be a direct transfer in the sense that there is going to be no routing in terms of the profit and loss. We don't route anything in the P&L. Tab 1 is always directly shifted to tab 2. It's an internal movement within the SOKI. It never gets routed in the income statement. And if he says on redemption that he wants, let's say, shares, then this money is supposed to be transferred in terms of security premium. Then this money gets transferred in terms of security premium. So when he says, I want shares, then the money which is there in tab 1 gets shifted to the security premium. And this is again supposed to be a direct transfer itself. So I hope you got the picture in terms of tab 1. A thumbs up would do. I hope you're clear on the origination and on the derecognition of tab 1. When does it get created and when does it get derecognized? It's an internal shifting from 1 to 2 on a disposal, on the derecognition. That's great. Super. Now let's come to the inputs in terms of the tab number 3. Now, in terms of tab number 3, what comes to my mind is the various standards where the concept of OCI comes into account. Index 16 and Index 38. That's one. So one area which creates this is Index 16 as well as Index 38, which creates what is called a revaluation surplus. which creates what is called a revaluation surplus. The other set of standards which creates this concept is called Ind AS 21. Ind AS 21 creates what is called a foreign currency translation reserve, that is called FCTR. And then comes the Ind AS 109. Before that is also Ind AS 19, but I've not put that Ind AS 19 to the list. I'll come to that. Then there is plethora of inputs which comes from Ind AS 109, and in terms of Ind AS 109, we get things like debt investments, we get things like equity investments, and we also get a cash flow hedge reserve as well. So there is a concept of a debt investments which is measured at OCI, or there is a concept of equity investments at OCI, or there is a cash flow hedge reserve, that is CFHR. So if you ask me, the standards are 16, 38, 21, 109 and 19. Is there any other standard? No. So let me remind you, there is an exception to the tab number 3. There is an exception which is there in terms of the tab number 3, which is Ind AS 19. Ind AS 19 employee benefit standards, actuarial gains and losses are taken in OCI, but they're not taken in tab 3. Every time you take things in the other comprehensive income, they always enter in the tab number 3. But Ind AS 19 is the one exception where the amount is not taken in tab 3. So I would say the exception to the tab 3 is Ind AS 19, and this is supposed to be merged, or you can say a separate disclosure is done for that. So Ind AS 19, we can say the actuarial gain or the actuarial loss enters the retained earning and disclosed separately in notes. And it is disclosed separately in notes. It is disclosed in the notes as well that this RE includes how much actual gain or loss. So Ind AS 19 is the only exception to the tab number 3. Everything which goes in the OCI is always taken in terms of tab 3, but Ind AS 19 is one exception where the money is taken in terms of retained earnings. And in this particular case, to tell you that this is, of course, a case of OCI NR. It's a case of OCI that is no recycling. But it is always merged with the retained earning column itself. Now let's walk through that what are these various standards saying? When does it get created? So the creation is this standard. The creations is these standards. So let's also put it across that when it comes to revaluation surplus, it is no recycling. FCTR is recycling. Debt investments is recycling. Equity is no recycling. And the cash flow hedge reserve is also recycling. So we know that revaluation surplus is without a recycling. FCTR, debt investments, cash flow hedge reserve. So 3 items are R. 1, 2, 3. 3 items are NR. It's easy to remember. There are basically 6 total items which leads to the creation of an OCI. One is Ind AS 16 and 38. As per the order, Ind AS 19. Then there is Ind AS 21. Then there is supposed to be Ind AS 109, which is creating a total of 3 components of, you can say, OCI. Ind AS 1638 is no recycling, FCTR is recycling, and debt investments recycling. Rest is no recycling, and CFHR this. Now let's see how does it gets derecognized. Let's see now the derecognitions part as well. So let's, I think, take you to the derecognition part. The revaluation surplus is transferred to the retained earnings, and this is on disposal. This is on the disposal of the assets. Though I can also make an annual transfer, to the extent of the additional depreciation. So it is either disposal one time, it can be either disposal one time, or you get a chance of making an annual transfer which is to the extent of additional depreciation. You'll recall the principles in Ind AS 16. So the amount which is supposed to be pushed from the revaluation surplus to the RE is either on a disposal. So either you do it on disposal one time, or it is an annual transfer every year, which is to the extent of additional depreciation. And of course, it is a direct transfer. And of course, it is a direct transfer. Now comes the concept of Ind AS 21. So as far as Ind AS 21 is concerned, this money is also shifted to RE. This money is also shifted to RE, but this is done, you can say, again on the disposal of foreign operation. This is again done at the time of disposal of foreign operation, but this is not a direct transfer. It is supposed to be indirect transfer. Indirect in the sense that the accumulated amount in FCTR is taken in the P&L in the year of disposal. In this case, the accumulated amounts will be directly pushed into RE, but in this case, the accumulated amount is taken in the P&L. So when you dispose of the foreign operations, the disposal of the foreign operations would lead to a transfer in the P&L, and then it goes in the RE indirectly. Now comes the case of a debt investment. So even debt investments is again going to go to RE, and this will again be on the disposal of the investment. This will again be on the disposal of the investment, and this is also supposed to be an indirect transfer itself. So whenever it is supposed to be a case of NR, it's direct transfer, shifting from one component of equity to another component of equity. But whenever it is a case of R, it is supposed to be indirect transfer. You root it in the P&L, and then it enters the RE. So I think let's make a mention that when I say indirect in nature, the indirect means that accumulated balances. The indirect means that the accumulated balances, the accumulated balance in tab 3 is taken to profit and loss account, is taken to the profit and loss account. So you're going to take this amount in the profit and loss account in this case. Okay, now coming to the equity investments, this is again going to be a direct transfer on disposal. So this is, again, we can put it like this. Let's draw the lines good. So this is joined out here. This is also joined out here. So this is also on the disposal of the investment, but this is a direct transfer because this is a case of NR. So you can see wherever R is written, it is indirect. Wherever NR is written, it is direct. Now comes the interesting part in terms of CFHR. If you remember, it is supposed to be either taken to the RE directly, indirectly, or adjusted to the cost of the asset. This is another interesting inputs to watch. So we can say in terms of CFHR, I'll put it like this. In terms of cash flow hedge reserve, we can say either. So we can say depending upon the hedged item. So this is all dependent upon the hedged item. So I would say depending upon the hedged item. If you remember, if the hedged item is inventory, then it is taken in the P&L. The accumulated balance is taken in the P&L. But if it is a PPE, it gets adjusted to the cost of the asset. So we can say depending upon the hedged item, like for example, it is inventory, or like for example, if it is PPE, if it is inventory, it is directly transferred, indirectly transferred to RE. So in this particular case, if it is a case of inventory, it is indirectly transferred to tab 2. It is indirectly transferred to tab 2, which is RE. And if it is PPE, it is adjusted to the cost of PPE. So it is not directly taken in one go. So this is like one go, and this is like over a period of time. This is over a period of time. So I think if you've done the hedge accounting, you will relate to what I'm trying to say in this connects. How wonderful indeed. I guess, friends, we get the entire inputs in terms of the other comprehensive incomes as well. I hope this chart really helps you. The measurement based chart and this particular chart, it's all arising out of the application. But this is not the application of the framework, let me tell you. Don't relate this to the conceptual framework under Ind AS, because the framework is not discussing about the concept of other comprehensive income. So this is just an application out here. Wonderful indeed. Thank you very much indeed on that. Right, friends. So I think I have covered the aspects in terms of the major component of the conceptual framework. Now there are small inputs here and there, which is given in the standard, given in the framework. So they are theoretical inputs. So maybe you can read the basic concepts of the recognition parameters, on the derecognition parameters, but the major practical connect which was there was on the measurement base. So I thought I'll take maximum of my time discussing the measurement aspects to you. I think that brings us to the end of our discussions as well. And this also brings us to the end of my inputs of chapters to be done with you as well. So this is what I'll be looking forward later, of course, to meet you sometime. But I think this is my portions done. Business combinations, consolidations, financial instruments. Really thankful to the Institute for giving this wonderful opportunity to interact with all of you. And I think it's been almost like, last year end to the beginning of this year. What a good end of the year and a good start to begin with. Right, friends. So over to you for any questions coming on your minds at this stage.
Sir, we are left with no question in our mind. The way you teach itself brings into the question in our mind. They kill itself.
Thank you so
Not
much
only
indeed. Okay, I've got a very interesting input from Ginny. Sir, it is very much privileged to us to be learned the very much big and tough part of effort from you. You made each topic simple for us to understand and remember. Your teaching skill and teaching style is very much nice. Thank you very much. We'll always be grateful you to become the guru. Thank you so much, sir. I am really feel blessed on this with such a wonderful audience giving me such wonderful inputs. I feel really truly blessed on that. Sanya will surely miss the classes. I consider you an accounting celebrity and your classes have been a dream come true. Thank you so much, Sanya. That means a lot to me. This is the love and affection with which, it encourages us to do a little much better each time, to deliver things much better. So that's really wonderful. I wish you all the best for your exams. Definitely we'll be connected otherwise as well. I guess there might be some other topics coming in, so maybe I'll get definitely connected with you. So thank you very much indeed on that. Monica, you teach very well and it helps us a lot. Thank you, Monica. Thank you very much indeed on that. So I think, friends, on that note, I take leave from you. So all the best and see you soon. Thank you. Bye-bye and take care. Today was very heavy, not because the concept was tough, but because today was the last class. Oh my God. It's always the beginning. Don't worry. We'll still be in touch, of course. Haji, thank you. Same to you, Ji. Bye-bye.
Thank you, sir.
Thank